Hi, everybody. Welcome to another episode of Stock Talk. This is episode 37. My name is Amin Reina. I'm an investment coach here at Sage Investors. And today's episode is really dedicated to the Canadian crowd because I'm talking about some changes in the investing environment that impacts really Canadian investing environment, not so much. So if you're in the U.S. and you're watching this, you're probably going to be glazing over a lot of this. So it might be a lot for you today, but it might be some good information that you want to talk about from a transparency and fee perspective. So anyway, I want to talk today about CRM2. You probably heard this buzzword if you're from your advisor, or you've heard it from other banks or anything like that. CRM2 is a set of disclosures now that have been instituted that came into effect actually last week. And it basically requires mandates now that financial companies, specifically like companies that sell mutual funds or investment products type thing, to have to disclose clearly when they send out your annual financial statements, statements to investors or quarterly statements. They have to disclose now how much two things. Basically, they have to disclose in plain English how much you as an investor have had to pay in fees to own specific investment products, as well as also fees that your advisor has earned from selling you these particular investment products. So that's one side of it. And because historically a lot of that stuff has just kind of been buried in like numbers and prospectuses, and it's been really hard. It hasn't been very transparent as an investor to find out how much fees you're paying. Second thing that you have to disclose now is performance. They have to disclose in plain language how effectively your investments have been performing, both individually and collectively in your portfolio. So there's some standards now in how those elements have to be described. So it's created a lot of hand-wringing in the financial services industry. They've pretty much been against it and think they don't want to do it, and they haven't want to do it, but now they've been mandated to do that. And from a lot of people, in the investment in the community, the personal finance community, think this is a really good thing because now we're going to get some transparency, and a lot of the things that have kind of been buried in opaqueness are now going to get opened up. So that's a good thing. So what are the impacts? What are the potential impacts of this type of CRM2 on the investing climate? Is it going to change a lot of the way in terms of how the financial services industry discloses and it deals with the relationships that they have with investors and clients? So I kind of wrote a blog about this actually over a year or so ago, talking about potentially what could happen from this. So a lot of this is if you go on my website, you can read the blog that I posted on it. But I thought I'd just share with you what I think is going to happen, the impacts of this CRM2 thing, because it's a big deal. I think it is a big deal. It's going to impact investors. So the way I look at it is what potentially could happen. What could happen? What's the impact of this right away? Well, as soon as people find out how much they're paying in fees, and especially here in Canada, because we're talking about mutual funds that charge 2 to 4 to 5% in expense costs. That's a significant chunk of cash that's taken out of your portfolio every year. And if you're doing that over a 10, 20, 30-year period, that's a lot of money that's going out of your pocket and into a financial services company's pocket. And that's just not cool. So when people see on their statements in plain English that this is what they're paying, and historically, most investors probably don't even think they're paying any fees. They're just putting money into a mutual fund or a stock or something and not paying any transaction costs because they don't see that number. Once you see that number now, it's going to create a lot of shock. It's going to be sticker shock for a lot of people, and they're not going to take it. And chances are there's going to be a good chunk of people that are just going to say, I'm done with you talking to your advisor. I'm done with you. I'm going to go somewhere else that's going to give me a better deal and charge me a more reasonable rate. So that's what we've seen. Now, in other countries, specifically in Australia and Great Britain, they've implemented a similar type of regulatory requirement, and the impacts have been profound. In Australia, when they implemented this type of CRM2 kind of provision, they saw ETF sales just explode, literally doubled overnight. And because people know now, why am I putting money into a high expensive mutual fund when I can put my money into a similar product that's going to charge me, instead of 2%, it's going to charge me like 0.25%. Big impact. In Great Britain, they implemented a similar thing, and they saw a drop in terms of high costly investment products go down and money going into ETFs and passively managed kind of portfolios. So that's probably what's going to happen. When you're looking at it from that perspective. But then I look at other things that that's going to happen at a certain level, but then what's really going to happen, I think, are the real impacts of this thing is, as much as people are saying people are just going to leave their advisor and switch teams and leave their bank and go somewhere else. This is in Canada. In Canada, we're Canadians, we're pretty stable kind of people in the sense that we don't like to kind of rock the boat a little bit and move around and shop around kind of thing. Once we're embedded, especially when it comes to when we deal with banks, once we're entrenched in a bank, chances are we're going to stay there for 10, 20 years. I can say it myself. I've been in the same bank since I was, like, my first bank account, I opened it up when I was like 15 years old, and I'm still with that same bank, and I do all my mortgage, and I do all my investing, and a good chunk of it, I do it through that same bank because it's just convenience. It's just like, I don't want to go there. I don't want to move around. I don't want to go through the hassle and the paperwork and of just doing that stuff. So people get a lot of inertia. So I wouldn't be surprised, like, as much as people saying people are just going to leave their advisor, I wouldn't be surprised if a good chunk of people just stick around. The second thing is, like, the extent of people moving advisors or changing products or things like that is going to depend on the market. If we're in a bull market while a lot of this stuff is starting to be implemented, then chances are I think people are just going to be more than happy to stick around. But if the changes that get implemented within a bear market or a really depressed kind of market, I think then you're going to probably see a lot more movement of people changing advisors and changing services. One thing you're going to start seeing in the financial services, and we're seeing it right now, and I'm seeing it in spades, is you're going to see a lot of rebranding of financial products away from these high-cost mutual fund kind of actively managed products. That doesn't mean they're going to stop doing that, but they're just going to rebrand it, repackage it into another format. And that most format that's probably going to be more relevant, you're going to see, is into the ETF model. You're probably going to see more actively managed ETFs. They're going to charge higher MERs, charge higher expense ratios compared to maybe less than what a traditional mutual fund is, but they're going to be higher nonetheless because, as I said, financial companies are in business, they're there to make money, and so they have to find margin somewhere. And so that's probably, you're going to see some rebranding. Second thing you're going to see is you're going to probably see a lot of financial advisors just get out of the business and start selling other types of investment financial products like insurance, life insurance, property insurance. It's happening already. A lot of companies I'm hearing stories of advisors who've just basically given up their license and are just saying, you know what, I'm just going to hang up a shingle and just sell insurance products because insurance is not covered under the CRM2 provision. So, and in that you can do anything you want, you can disclose anything you want as an advisor. It's pretty much free reign there. So you're probably going to see a lot more insurance products being pushed out there. A thing we're probably going to see also is that CRM2, even though it's officially kicked in, you're probably not going to see the first set of financial statements and reports going out to customers, to clients, really not going out until probably early next year. And what's going to happen, and this is what some people I've talked to within the industry have said, there's probably, in the last 4 or 5 months, there's been a heck of a lot of churning going on. You've probably seen a lot of advisors just knowing that this disclosure is going to have to come in, just getting their clients out of getting their clients into more expensive mutual fund products. Basically, just kind of slip it in under everything before the provisions kick in, and so it's kind of like the last gasp of grabbing as much commission as they can and pushing people into products, higher priced products. Wouldn't be surprised to see a lot of churning going, or has seen a lot of churning going on. A bigger impact that I hear that might be an impact of this type of CRM2, this openness and disclosure, you might see financial advisors just not catering and not willing to even accept business from low net worth clients. It might be harder if you're not have 100,000 or 500,000 in net worth. It's probably going to be harder for you to find somebody like a professional offering you financial advice out there because there's just not going to be the money there for the advisor to do it, and they're just not going to be interested in talking. So it might be harder for lower net worth people and lower income people with lower amount of assets to invest to find somebody to give you financial advice, and that's kind of concerning too. So it's going to become financial advice. It's just going to be a very high level elite kind of thing. And that's not cool, and I think any person out there has a right to invest and a right to grow savings and earn money and have access to services that they need. So that's something I can see. And so from that perspective, as much as you'll see financial advisors cutting off people or cutting off lower value clients, it actually could become a boon to this newly emerging industry of robo-advisors who are catering to the people with lower assets, lower numbers of assets to invest. And it could be a boon for them. And so I wouldn't be surprised to see robo-advisors, in terms of assets under management, take in more money and grow their pile of cash in that way. Now, performance is a totally different subject, and I'm babbled on and write about it extensively in terms of how those type of services perform. But that's a totally different conversation. Finally, like anything, when a new regulation comes in, people always look for shortcuts and look for loopholes and workarounds. So as we speak right now, I know the financial services industry is probably looking for ways how they can get around a lot of these provisions and not have to disclose some of the expenses and performance and kind of muddy the waters a bit like that. So I wouldn't be surprised to see that. So that. And when it does, that's where the concept of, you can implement a regulation and implement a standard, but it has to be enforced. And so that's the question, is how much enforcement of this is going to be done by the regulatory agencies about this. So that's the big question on that. So there's a lot of things, it's just a little provision that's hopefully going to, in the spirit of it, it's going to open up transparency, make investors more aware of their costs, and also really how well their portfolios are doing. But it's just, there's all kinds of things that happen that could really muddy the waters, and financial services industry is notorious for just kind of muddying the waters a bit on disclosure. So something to look out for, something to keep an eye on out there. But I think it's a good first step. And as I say, as an investor, I want to know how much I'm paying for things, and I want to know if I'm making any money, because that's really why I'm into it. I'm not into investing just to prop up somebody's back office, to prop up a business. I'm here to make money. And so ultimately, this type of disclosure hopefully is going to help investors understand and answer those two fundamental questions. So we'll see how it works out, and I think it's a good step. So that's all I got for you today. And if you have any questions about this or anything other investing topics you want me to talk about, feel free to give me a shout through two ways: through my website, www.sageinvestors.ca. Just send me an email through the website, or you can hit me up through Twitter. I'm on there all the time, commenting, observing about market movements of the day, and tweeting my own personal investing decisions. You can find me through the handle @SageInvestors, so you can direct message me through there. So that's all I got for you today. It's a lovely day out here. I think I'm going to go out and enjoy it a little bit. It's another episode of Stock Talk. My name is Amin Reina of Sage Investors, and we'll catch you again another time. Cheers.